Welcome back to Investing Talk Podcast.
We have a huge one for you today. We're digging into the absolute titan of the tech world, Microsoft.
The giant.
And, the stakes really could not be higher. We are staring at a company that is, well, it's the backbone of enterprise software.
For sure.
Yet the stock is currently sitting at, what, $401.32?
Yep, and that's a significant, a really painful drop year to date.
It is. So the multi-billion-dollar question we have to answer is this it? Is the historic run over? Or, and this is the interesting part, is this a golden opportunity in disguise?
A huge question. But hey, before we get into all that, as usual, before we start, subscribe, like, and comment to this video to support the show.
It really helps us out.
It does. Okay, let's get into it.
Let's do it.
Right, so let's try to unpack this scene, because choppy just doesn't do it justice. It has been a brutal week for tech.
Brutal is the word.
You look at a peer like Oracle,
Mm-hmm.
and they're just ripping of 12% on cloud optimism. And then you see Microsoft.
Diverging, going the other way. It's ugly. And we're seeing these year-to-date losses across the whole Magnificent Seven. It just feels heavier with Microsoft, It really makes you ask if that dominance is finally fading.
I see the red on the screen. I
Mhm.
feel it. The sentiment shift is palpable.
Right.
But if you pull back for a second, I think the market is missing a fundamental discrepancy here.
Okay, what are you seeing?
While the stock price is bleeding out, the internal metrics, specifically Microsoft's quality score, it hasn't just held steady, it has surged. We are talking about a move into the top 10% of all companies for operational efficiency.
The top 10%, that feels totally counterintuitive. When a stock drops 20%, you assume the machine is breaking down.
And you're saying it's running better than ever.
Much better. And that's what's so fascinating about this moment. The street is panicking about the chart, but operationally, the machine is smoother than it's been in years.
And everyone's forgetting about the agentic AI revolution set for this year.
Oh.
I think they're bored of chatbots and missing the real pivot. Okay, we are definitely going to get to the agentic stuff because that is the buzzword of the year. But I want to ground this in cold hard cash first.
The numbers.
Let's look at Q4 2025. Revenue hit $81.7 billion.
Pause on that. $81 billion in 3 months.
A massive number. But I want to zoom in on Azure, the cloud, because that's the engine room. If Azure sneezes,
The whole market catches a cold.
it does. So Azure grew 39% year over year.
Which is incredible velocity at that scale.
It is huge. I'll grant you that. But here's where it gets a little worrying for the growth story.
Uh-oh.
That 39%, it's a deceleration. The previous quarter was 40%.
Oh.
Now, I know what you're going to say, it's only 1%. But in this world, even a 1% slip sets off alarm bells. It suggests the hypergrowth might be cooling.
And that's why the stock is tanking.
I think it's exactly why. The market hates deceleration more than anything else.
I hear that argument, I do. It is the standard bear case. The law of large numbers always wins. But let's look at the expectations game.
Go on.
That 39% actually beat analyst expectations. Wall Street was looking for 37, maybe 38%?
So they're still outperforming the consensus.
By a lot. So you call it a slowdown, I call it massive growth. That's hard to even comprehend.
But is it efficient growth? We know they are spending a fortune on AI. The CapEx is astronomical.
Which brings us right back to that quality score I mentioned.
The jump from 79 to 90.
Exactly. It jumped from 79.51 to 90.08. That huge leap tells us that even while pouring billions into AI, they are managing their margins with elite efficiency. They aren't just burning cash.
Speaking of burning cash, though, the CapEx for AI is eye-watering. NVIDIA chips are not cheap. So how long can they keep that up before it eats into profits?
And that's the beauty of their balance sheet. This is what makes Microsoft different. You compare them to the other big 5 hyperscalers.
Amazon, Google.
Their free cash flow resilience is just superior. They have the cash on hand to sustain this AI spending that scares everyone else.
So they can play offense while others are just trying to balance the checkbook.
That is their huge competitive advantage right now.
Okay, so they have the money, I'll concede that.
Yeah.
But do they have the moat? Everyone is doing AI now.
It's not just about the cloud or the model, it's the ecosystem. The data shows 80% of the Fortune 500 are already using active AI agents in the Microsoft environment.
80%.
80%. That is the moat. It's the distribution.
That is a staggering number.
It's market dominance. And here's the future catalyst the market is ignoring. The company guidance is signaling Copilot could automate most white-collar tasks in the next 12 to 18 months.
Whoa, slow down. 12 to 18 months for most tasks? That seems incredibly fast.
It is fast, but think about it. This isn't just a chatbot. This is about reducing handoffs, automating report generation, scheduling.
The boring stuff.
The stuff that costs businesses millions. That drives sticky adoption. Once you fire the temp agency because Copilot does the work, you are never going to switch.
It becomes too painful to leave.
The stickiest product imaginable.
It sounds impressive. Still a prove-it story for me, but let's pivot to the charts and see if the market agrees.
Let's do it.
Because right now, the price action is just painful. I don't care how good the quality score is if my portfolio's red.
Fair enough.
Stock's at $401.32. That's a roughly 20% drop year to date. And what stands out is the divergence.
It's not moving with its peers.
No. Apple and Amazon are tumbling, and Microsoft is falling right with them. It's totally failing to catch that Oracle wave. Why is Microsoft being punished while Oracle is celebrated?
I think it's expectations. But I interpret that drop differently. Where you see a broken chart, I see consolidation near key historical levels.
Consolidation. It looks like capitulation selling to me. It feels like investors are nervous about the AI spending and are just throwing in the towel.
And that's a knee-jerk reaction. When you pair that price drop with the quality rank surge, it creates a kind of psychological floor.
How so?
The company is fundamentally getting better while the price gets cheaper. That's technical valuation upside potential. The stock is getting oversold relative to its actual strength.
It's a mixed profile for sure. But choppy tech action is an understatement. It's hard to catch a falling knife, you know.
It is, but usually the moment everyone is afraid to catch it is when the smart money is getting ready to buy. That's when sentiment disconnects from fundamentals.
Well, speaking of sentiment, let's move on to market perception. Because I'm looking at the scores here, and they are not screaming buy.
What are you seeing?
The quantitative sentiment score is a flat 0, neutral.
0.
For the company that's supposed to be leading the AI revolution, neutral feels really underwhelming. It tells me the market is bored. Or maybe even worse, indifferent.
That score needs some nuance, though. You have to remember how those algorithms work. They just scrape headlines.
The headlines are bad.
The headlines are all stock tanking, price drops, tech sell-off. The score is dragged down by the price action itself. It's a feedback loop. But the undercurrents, the actual business news, are incredibly bullish.
Okay, so give me an example of a bullish undercurrent.
Look at the Nebius partnership. We are talking multi-billion-dollar deals for infrastructure in Europe. That is a massive signal of institutional confidence.
That's a fair point. Infrastructure is a long-term bet.
You don't sign those deals with a sinking ship.
Although I will point out, I haven't seen any Form 4s or 13Fs, no big insider buying recently. If the execs really thought the stock was a steal at $400, wouldn't they be buying it up?
We haven't seen filings, true. But the big institutional funds, they love that free cash flow they'll be accumulating. But I want to go back to what you said about hype.
Yeah.
The market is missing the shift from simple AI to agentic AI. That's the real disconnect.
You mentioned this before, agentic AI. Break that down for me. What does that actually mean for an investor?
It's the difference between a tool and a worker. So far, we've had tools. You say, write an email, it writes an email.
Right. Generative AI.
But 2026 is the year of end-to-end workflows, multi-agent coordination. You'll say, plan a marketing campaign. And the AI won't just write a plan. It will email designers, schedule meetings, book ad space.
So it's not just generating text. It's doing things. It's taking action.
Exactly. Copilot Studio enables this now. And it's multi-model. It even supports Anthropic. They're being agnostic to win the platform war.
And that, I assume, connects back to the sticky factor.
It creates the highest switching costs in the industry. If your AI agent knows your calendar, your email, your spreadsheets, you are never leaving that ecosystem. It becomes your company's brain.
It sounds like a digital prison, but a profitable one for shareholders.
Yeah.
Okay, I get the bull case, but I want to play devil's advocate. Let's look at what could go wrong.
We have to. Blind optimism is how you lose money.
For me, risk number one is ROI scrutiny. The show me the money argument. Investors are selling because they see billions going out for chips and they're asking, where's the profit? The market is tired of promises.
The gap between spending and earning, it's the valley of death for tech stocks.
But risk number two, that sequential deceleration. I have to keep harping on the Azure dip, 40% to 39. If next quarter it's 38, then 37. The PE ratio is going to crash.
It's a valid concern. If that trend accelerates, the thesis changes.
And finally, risk 3, macro volatility, the Mag 7 weakness. If the whole sector rotates, Microsoft gets dragged down no matter what. You can't fight the tide.
Those are all real risks. I'm not dismissing them. But
Right.
my rebuttal is that these risks are manageable, and more importantly, they're largely priced in.
You think the bad news is already in the stock price?
I do. The stock is already down 20%. You're not buying at the top. You're buying after the punishment has been handed out. And that free cash flow resilience protects them from the worst-case macro scenarios. They can weather a recession better than almost anyone.
The fortress balance sheet argument. It's comforting, but it doesn't guarantee the stock goes up.
It guarantees they have staying power. And in tech, staying power is everything.
So, after all that, the slowing growth, the spending, the agentic future, the ugly chart. Let's move to the final verdict. Where do you land?
Okay. After looking at everything, I'm assigning a bullish score of 8 out of 10.
8 out of 10. That is surprisingly high, given the chart looks like a ski slope.
It's high because the chart looks like a ski slope. Here's the elevator pitch. Microsoft is a screaming buy, specifically because of that 20% drop.
So if it were still at 500, you'd be more neutral.
Exactly. At $400, you're getting a company with $81 billion in quarterly revenue and a quality score of 90 at a discount. You're getting quality at a value price.
So it's a multi-year hold, betting on that 2026 agent scaling.
That's the thesis. You have to look past the next 3 months and look at the next 3 years.
I can see the logic. I am still very wary of that Azure number, though.
You have to be.
For anyone listening, you have to watch that Azure percentage in April. If that number drops again significantly, this thesis might need a serious review.
That's fair. April will be the test. But
Yep.
for now, I think the discount is too good to ignore.
That's it for today. Don't forget to subscribe, like, and comment regarding which stock we should cover next. See you in the next episode.